All right, welcome everyone. It's just after 11, so we're going to get started. Once again, welcome to everyone to the Lumsden and McCormick webinar, Changes to Lease Accounting and How It Impacts Your Organization. My name is Maria Gambacorda, and I will serve as your host for the webinar today. I know many of you have attended multiple webinars in this series, and we're glad to have you back again today. And we also want to welcome those who are attending the series for the first time. Before we get to introductions, I'm going to go through a few housekeeping items, especially for those who are new to a Lumsden and McCormick webinar. So this webinar is being recorded. We will share a link with everyone. It will be posted on our website sometime tomorrow. We'll share that along with the slide deck, so you can expect an email tomorrow. Both the chat feature and the Q&A are enabled. So if you have a comment or a question for me, you can put that in the chat. And any questions regarding the content lease accounting for Max and Bob can go in the Q&A section. And we're going to hold questions to the end. So as they're going through the slides, if you have a question, put it in the Q&A, and then we'll address it at the close of the webinar. Okay, so moving on to CPE. We're offering 1 hour of CPE for this event, so all the polling and survey questions need to be answered. There's 4 polling questions. To qualify for CPE, you need to answer 3 of the 4. And you'll be prompted for each, and then we'll share the results. And there's also a very short survey that will automatically launch when you close out of the webinar. If you can complete that too, again, that is required for CPE. So for CPE certificates, we'll send them out to you via email in about the next 30 days, and you will see them. It's coming from an email, and I'm just going to put it out in Teams in the chat. You'll see it. It's from support@polera.com. So make sure that email is saved in your contacts, and then it will avoid it going to spam. Okay, so as you know, this is a webinar series. This is the 5th out of a 6-part series, and our final one is on August 10th, and that's talking about the pandemic and our economy and where we stand. So you can see a chat to that, a link to that in the chat, along with a link to recordings for the past webinars. So today we are joined by 2 members of our audit team, Max Donlin and Bob Torella. They're both members, like I said, of the audit department. Max's primary focus is on accounting and auditing matters related to commercial businesses and nonprofit organizations, including healthcare. Bob also specializes in auditing and accounting for commercial businesses and nonprofits, including educational and cultural organizations. So I linked in the chat their links to their bios as well as their emails if you want to reach out to them directly. So before I turn the program over to Max and Bob, I'm going to launch our first polling question. So here it is. We tried to do something a little fun today. So you have to pick which day. Today is July 27th. What holiday is celebrated today? So just randomly pick, and we'll give this about another 30 seconds. And of course, we'll share the answer with everyone. All right, there's still about 10 of you that need to respond. So if you want your CPE, got to get that polling question in. All right, I'm going to end the polling, and we will share the results. So let's see. So most of you thought that the National Bowling Day is the correct answer. It's actually not. And Mac's going to advance the slide. It's actually National Scotch Day. So on your way home from work, you guys can pick up a bottle of scotch and toast to National Scotch Day. So anyway, again, something fun to kick us off this morning. So now I'm going to turn the program over to Bob and Max.
All right, thanks, Maria. And thanks to all of you guys for joining us today to chat about our new lease standard and how it's going to impact your organization. So what we're going to talk about today is we're going to go through the current guidance and the existing lease treatment just as a refresher. Then we'll dive into the new accounting standard for leases, go through some implementation and related impacts to your organization, and then wrap it up with some preparation tips, how you guys can get ready for implementing this new standard. So starting things off with the current guidance, what is a lease under the guidance today? A lease is an arrangement that conveys the right to use and control property, plant, or equipment by the lessee. Now you'll see when we get into the new standard, this is what is going to change a little bit, the actual definition of a lease. Now currently, most of you are aware there's two different types of leases out there. And depending on the type of lease will result in two different types of accounting treatment essentially. The first type of lease is a capital lease. And to meet a capital lease, or to be a capital lease, you must meet one of the four criteria. And the four criteria are: the lease agreement has to contain a transfer of ownership. Essentially, the lessee will own the property outright at the end of the lease. Or if it contains a bargain purchase option, let's say you can buy the property for $1 or an extremely discounted price at the end of the lease. That would be a bargain purchase option and classify as a capital lease. Or the lease term exceeds 75% of the useful life of the asset. Or if the present value of the minimum future lease payments are at least 90% of the fair value of the asset, it would be classified as a capital lease. So if it meets any one of these four criteria, we treat it as a capital lease today. And if it doesn't meet any of these criteria, all the other leases are operating leases. So now moving on to the treatment of the leases and how they're recognized today. If it's deemed to be a capital lease, it's recorded as a liability at the present value of the future lease payments in a related capital asset. And then the liability is amortized and reduced using the effective interest method. And then the asset is amortized essentially on a straight line basis over the life of the lease. Now, operating leases, these are the ones that most people are probably more familiar with and what you deal with on an annual basis. But currently, operating leases are not on the balance sheet. The recognition really is you recognize the lease and rent expense as it's incurred over the term of the lease. But there is no obligation or liability or asset on the balance sheet as the current guidance sits. However, in both cases, you are required to disclose the future payments of both. So the only information on any commitment or obligation for operating leases is in the footnotes to your financial statements. Now that we have a little background on kind of how leases work today, I'm going to pass it over to Max, and he's going to dive into the new lease standard.
Hey, thanks, Bob. Before we dive into some of the more technical components of Accounting Standards Update, ASU 2016-02, also referred to as Accounting Standards Codification Topic 842. So I'll call this ASC 842 throughout this presentation. Let's talk about the history of lease accounting briefly. Lease accounting has seen limited changes since Financial Accounting Standards Board, FASB number 13, which was issued in November 1976. So quite a few decades ago at this point. ASU 2016-02 is a decade-long joint project between the FASB and the International Accounting Standards Board, the IASB. The ASU was issued in February 2016. The adoption of the ASU has been ongoing, which we'll talk about in more detail in the coming slides. For our purposes today, we'll focus primarily on the lessee accounting, as the lessor accounting changes are relatively minor. In general, these changes to lessor accounting are centered around aligning the accounting with revenue recognition requirements, which you may recall from a few years ago, which fell under ASC topic 606. So I would anticipate the question that runs through everyone's mind is, why is the change necessary, and what is FASB trying to achieve with ASC 842? Well, in essence, the change is targeting to portray a more faithful representation of an organization's leasing activities. So what does this mean? I think some Some figures sort of help quantify this and sort of drive the point home. So according to a 2005 SEC estimate, there were approximately 1.25 trillion in off-balance sheet operating lease commitments for SEC registrants. So from the SEC's perspective, operating leasing is the largest form of off-balance sheet financing, as operating leases have historically not appeared on an entity's balance sheet, but rather through their income statement as expense. So when you consider entities beyond SEC registrants, the volume of off-balance sheet financing increases dramatically. So what's the good news out of all of this? Well, due to challenges caused by the COVID-19 pandemic, FASB has provided some relief and delayed the issuance of the standard, which was good news for many companies, as it has given them more time to consider the impacts of implementation and prepare themselves accordingly. As we'll discuss later in this presentation, it's never too early to start considering the impact of the lease standard. The original adoption for public entities began for reporting periods beginning after December 15th, 2018. So for calendar year entities in 2019, if the deferral period that was offered due to the COVID-19 pandemic was elected, the standard will go into effect for the majority of other entities for fiscal years beginning after December 15th, 2021. So calendar year entities 2022 that have not previously adopted. And per usual, in typical FASB fashion, early adoption is still permitted. So I think where we should start our discussion is just defining what a lease is. Simply put, a lease is a contract that conveys the right to use an asset for a period of time in exchange for consideration. The lessor provides a right of use asset to the lessee, while the lessee provides payments in return. The payments would be the consideration in this case. Under the new standard, the lessee will recognize a right of use asset and liability that arise as a result of the leasing arrangement. All leases will create an asset and a liability for the lessee. So this is an improvement over previously generally accepted accounting principles, which do not require the lessee to recognize a liability in many leasing arrangements. If you think about operating leases, those only having an impact on an entity's P&L and not showing up on the balance sheet. So as Bob had discussed, under the current guidance, there have historically been two types of leases, your capital and your operating leases. Under ASC 842, there continues to be a two lease model approach. Those two types of leases being what is now known as a financing lease and the operating lease. Beginning first with the financing lease is most similar to a capital lease under the old standard. A lease will be classified as a finance lease if it transfers substantially all risk and rewards of ownership, i.e. it meets one of these 5 criteria that are outlined on this slide. The criteria are similar to the capital lease criteria, with the difference centered around that 5th criteria. Additionally, the capital lease criteria had what they called bright line tests, which previously associated with certain lines or certain requirements of the capital lease criteria, and those standards have been changed just a little bit, which I'll call out as I run through these 5 financing lease criteria below. So for a lease to be considered a financing lease, it must meet one of the 5 following elements to be considered. Ownership of the assets transferred to the lessee by the end of the lease term. The lessee has a purchase option that is reasonably certain to be exercised. The lease term is for a major part of the economic life of the asset. The bright line test under the capital lease previously was 75% of the economic life. The present value of minimum lease payments amounts to at least substantially all of the fair value of the leased asset. Previously, this was 90% of the fair value at the time of the lease, which was the associated bright line test with that. And then finally, the new test, the underlying asset is of such a specialized nature that it is expected to have no alternative use to the lessor at the end of the lease term. So similarly, if none of the above criteria are met, then the lease will be considered an operating lease. So later in this presentation, we will take a deeper look at the differences in recording each type of lease. Okay, now that we've identified the two types of leases under ASC 842, the financing and the operating leases, how do we identify if an arrangement qualifies as a lease? Well, a lease should be determined at the inception of the contract based upon two main criteria. First, whether the contract fulfillment depends on the use of an identified asset. What we need to consider here is whether the supplier has substantive right of substitution. This means that the supplier would not benefit from substitution and the customer can prevent substitution. The second main criteria is whether the contract conveys right to control the use of the identified asset for consideration for a period of time. The asset may be explicitly or implicitly specified. So what I mean by explicitly identified is that the asset has a certain serial number tagged to it so that it's unique in nature, or implicitly identified asset would be effectively the only asset that would satisfy the contract or the inability to substitute with a like asset, so a highly specialized asset if it's implicitly identified. A lessee has an identified asset when the lessee has both of the following criteria: the right to direct its use, meaning the decision-making authority over an asset and how and for what purpose the asset is used, including the right to change how and for what purpose the asset is used, and the ability to receive substantially all the economic benefits from the use of said assets. So moving on to polling question 2, are you attending this webinar to earn CPE credits? And I'll give you some time to answer.
We'll give it another few seconds. There's still a few of you that are need to answer. Thanks. Okay, I'm going to end the poll, and Max, you can continue then.
Okay, so moving on to embedded leases. I think it's important to note that not every lease has the word lease in it. That's because all contracts that meet the accounting definition of a lease may not be labeled as a lease. A contract is or contains a lease if it conveys the right to control the use of a specified asset over a period in exchange for consideration, a period of time in exchange for consideration. It's not uncommon for service contracts to convey to the customer the right to use a specified asset during a contract term. I have a few examples of this, and obviously these are very situationally dependent, but the first example is a company enters into a contract to advertise on a billboard. Although this contract could be written as an advertising service contract, the right to use the billboard may meet the definition of a lease. Alternative to this is a company enters into an arrangement with an IT organization to host its data on a dedicated server. An embedded lease within the IT hosting arrangement may be the company's right to direct the use of the specified server, which could meet the definition of a lease. Although it's possible that some of these contracts may not meet all aspects of the lease definition after considering the specific terms, it's critical that companies engage in analysis to identify and document contracts that may contain embedded leases. Many companies currently have contracts that contain embedded leases, and identifying these contracts and properly accounting for them requires some thoughtful analysis. So just thinking about best practices as to how you might identify if a contract had an embedded lease. First, I would look closely at all operations, meet with relevant departments and understand the type of service contracts that exist, and discuss the specific concepts of ASC 842 and the definition of a lease. Next, assess areas of risk and perform a risk assessment to identify where embedded leases are more likely to exist. Another good tactic would be to just simply review expense activity, perform a physical inspection of assets, and just walk through offices or manufacturing locations to identify assets that might not appear on an asset listing or registry. And then finally, just examining contracts. Obviously, this is more tedious and is going to require more of a fine-tooth comb going through these and identifying what the assets are attached to them and what the implementations of the contracts are calling for. So moving on to short-term leases under ASC 842, contracts with non-cancelable terms of less than 12 months might not qualify for the short-term lease exception if the entity is reasonably certain that renewal options will be exercised. The lease term, as defined under ASC 842, includes periods covered by the renewal options whose exercise is reasonably certain. The short-term lease exception is available only if the lease term, which includes periods covered by the renewal options whose exercise is reasonably certain, is less than 12 months. If the short-term lease policy election is made, it must be disclosed in the financial statements, and you would recognize the lease payment through the P&L on a straight line basis, unless it's a variable lease payment, which should be recognized as incurred. I would caution that prior to determining that a lease is a short-term lease, the entity should consider the existence of lease extensions and the likelihood of extending the arrangement when determining the overall lease term. Okay, so moving on to related party leases. Under previous lease guidance, related party leases often use substance over form in evaluating the existence of a lease. Under the new ASU, and unsurprisingly, the entity should use the legally enforceable terms and conditions of the leasing arrangement. And what I mean by this is best practice would be that in the separate financial statements of related parties, the classification and accounting for leases should be the same as for leases between unrelated parties. So I just want to touch briefly on components of a contract under ASC 842, identifying and separating the lease components of a contract that contains the right to use multiple assets. It's not a new requirement, but the effect of applying the components correctly is more significant under the new ASU. So when a contract has multiple components, the standard requires identification of separate lease components if the lessee can benefit from the right of use either on its own or together with other resources that are readily available to the lessee, or the right to use is neither highly dependent on nor highly interrelated with the other rights to use underlying assets in the contracts. The standard also requires separate accounting for non-lease components of a contract. These items may be an activity that transfers a separate good or service to the customer. For example, supplies or disposables. This could also include common area maintenance charges or allocated payments are considered non-lease period expenses. So the consideration, the payment in the contracts must be allocated between the lease and non-lease components, which is why it's so important to identify the separate components in a leasing arrangement. However, the FASB has allowed the lessee to elect a practical expedient to not separate out the lease and non-lease components and treat this as a single lease component if it's not practical to identify the separation in the two types of components. So moving on to the commencement date of a lease. This is the date on which a lessor makes an underlying asset available for use by a lessee. So this is really tied to the control of an asset and is not dependent on the timing of payments. This methodology is consistent with current US GAAP. So as an example, if you have a retailer who enters into a lease agreement with a mall operator and rent payments are set to begin once the retailer opens their store, which is anticipated to be in October, if the retailer installs leasehold improvements to customize the space to their requirements prior to the opening, and the lease allows the retailer exclusive access to the space beginning in August to install these said leasehold improvements, when would the lease begin? Well, the lease will begin in August, even though the rent payments begin in October, since the retailer has access to and can control the space beginning in August. So the commencement date will trigger the accounting for the lease. The next thing I wanted to discuss was the term of the lease and what should be considered when recording the lease. So the size of the right of use asset and liability are dependent upon identifying the correct lease term. So the lease term includes the non-cancelable period of the lease. The lessee should also consider the periods under option to extend the lease if the lessee is reasonably certain to exercise the option. The periods under option to terminate the lease if the lessee is reasonably certain not to exercise the option. So the term reasonably certain is a high threshold, which is substantially the same as reasonably assured in existing US GAAP. This includes an assessment of the economic incentives of the arrangement. So some things to consider when determining lease term is if the option to extend is controlled by the lessor, then I would assume extension of the lease. Or the contractual terms of leaving early, are there penalties associated with leaving the lease term early? How about the importance of the lease or the property to the lessee? Is it unique in nature, or is the ability to replace the property more difficult for a variety of reasons? How about the cost of moving or the leasehold improvements that have been done to the current asset? Or is there a reduction in payments if an option is exercised? Would you assume renewal in that instance? So I just wanted to walk through a quick example of this that has some sort of economic incentives of the arrangement. So a retailer enters into a 3-year lease agreement with a mall operator that includes 4 3-year renewal options. the retailer incurs costs of $50,000 in installing leasehold improvements to customize the space to its requirements, and other leasehold improvements have lives of 5 years. So what would the lease term be in this scenario? Well, we know that the non-cancelable base lease period is 3 years, but the leasehold improvements are 5 years. So we would assume that the first renewal option would be opted for, since they would have an economic incentive to opt for that first period, that first renewal period, because of the length of term of the leasehold improvements being 5 years. So the overall lease term in this instance would be 6 years. So then just discussing the components of lease payments. So when a lessee is calculating lease payments, they should include the following as it's applicable to the individual situation or the individual lease. They should consider the fixed lease payments, less any incentives to be paid by the lessor, any variable payments tied to an index. An example of an index may be like the consumer price index, CPI, or a specified rate based on the rate at the commencement of the lease. Any variable payments which are in substance fixed payments. One thing I'd note here is variable payments should be reassessed when the lease liability is reassessed for other reasons, such as contract modifications. Otherwise, changes in the index would be just simply period expenses. Any residual value guarantees, the exercise price of purchase option if the lessee is reasonably certain to exercise the option, termination penalties if the lease term reflects the lessee exercising option, and then finally fees paid to structure a special purpose entity. So I just had a quick example of this, and it's the same structure, the same example as the previous one. The retailer enters into a 3-year lease agreement with a mall operator that includes 4 3-year renewal options. We already determined that the term of the lease is 6 years due to significant leasehold improvements with a 5-year life. If rent payments are $10,000 annually, plus 2% of sales during the initial term, with base rent increasing 5% in each renewal period, what are the lease payments? Well, in this instance, the percentage rent based on sales is variable and thus would not be included in the lease payments, and you would expense as incurred. The lease payments for the first term would be $30,000 or $10,000 annually for base rent, and then $31,500, which would be for the second 3-year period, which would be 5% greater than the base rent period. So $61,500 over the 6-year lease term. So at this point, I'm going to turn it over to Bob to just talk about the implementation aspects.
Thanks, Max. So now that we've kind of gone through some of the technical components, the definitions of the new standard, let's get into, how are we going to implement this and what is it going to look like? So in both cases, whether it's a financing lease or an operating lease, the initial measurement or value recorded on the balance sheet is going to be, you're going to record a lease liability as well as a right of use asset. So the lease liability is recorded at the present value of the future minimum lease payments. Now, the big question on how to calculate this is what discount rate are we going to use to present value these future minimum lease payments. So this can either be the entity's incremental borrowing rate, if it's known. Essentially, the incremental borrowing rate would be, what similar rate can you get from a bank for a similar type of financing arrangement or loan? Or you can use the rate actually charged by the lessor if it's actually stated in the lease. Now, the good thing for private companies, they can elect a practical expedient and use the risk-free rate as the discount rate to present value their future minimum payments. But this is only for private companies too. Public companies are not allowed to elect this practical expedient. So then once you calculate your lease liability, then you would record your right of use asset along with it. Now, this represents the actual physical asset you're leasing, and it can be a different value than your lease liability. But you start off with your lease liability and you would add in any initial direct costs, any prepayments on the lease agreement, and back out any incentives you received by entering into this agreement. So for example, initial costs that would be added to the right of use asset would be if you had to buy out a previous lessee in order to obtain that property or equipment, or if you had to use a broker to find a specialized piece of equipment that is hard to come by, and you had to pay them a commission to find that piece of equipment. That would be an initial direct cost that would be added to the right of use asset. Prepayments are just as that, any deposits or advances on the agreement. And then incentives that you would back out of the right of use asset value would be, let's say, the new lessor bought you out of an old lease to get you this new shiny piece of equipment. So that compensation or that buyout of your old lease would be a reduction to your right of use asset. But in most cases, your lease liability should be the same as your right of use asset, but not necessarily always the case. So now moving on, that we have our right of use asset recorded and related liability. We're now going to walk through how we account for these lease payments and related amortization over the term of the lease. Thanks, Max. So now the recognition of these lease payments are dependent on whether it's going to be a financing lease or an operating lease. Can you switch the slide, Max, please? So let's say it's a financing lease. So the lease liability is now reduced using the effective interest method, which means more of the lease payment is going to be applied towards the interest expense earlier on in the lease compared to later in the lease. So it kind of front loads your payments in your interest expense in the earlier years of the lease, less than in the later terms, and opposite when you're looking at the principal payment on your lease liability. So your interest expense is recorded on a monthly or annual basis, depending on your actual lease payments. Then your right of use asset is amortized generally on a straight line basis over the term of the lease. Now your interest expense and amortization expense are recognized separately on your income statement, similar to kind of how you would do this with a capital lease or related debt payments today when we're talking about interest expense. Now, if we switch gears and say the lease is determined to be an operating lease, the lease liability is still reduced using the effective interest method. So your actual liability, the principal payment on your liability, is lower in the earlier part of the term and higher towards the end of the term. But the interest component of the effective interest method is recorded to the lease expense. There is no interest expense with an operating lease. Now, the lease expense should really represent the straight line amortization of your overall lease expense. So at the end of the day, it would represent what your annual or monthly payment would be. So then your difference between the interest component recorded as the lease expense and your amortized straight line lease expense as calculated is really your amortization of your right of use asset then. This is essentially your difference to achieve that straight line lease expense. Now, I know that's kind of a complicated way to get there, but at the end of the day, your lease expense will essentially equal your cash payment or your monthly payment from that respective lease. So now if we move on to the next slide, I think we have a polling question. What is your favorite summertime activity? Water sports, amusement parks, road trips, or gardening?
All right, Bob and Max, you guys need to answer this. What's your favorite?
I'd probably go with water sports if I had to choose out of the four. Not that I'm good at them, but they're the most fun.
Yeah, I would agree with that.
I'm going to go with a road trip.
Nice.
as long as I'm driving. Okay, I'll give this a few more seconds. There's about 10 more people that need to reply. All right, we're gonna end the poll, and it looks like, oh, road trip went out. So I'm gonna share the results, and you can see road trip went out. Okay, thank you.
All right, so moving on, we've gone through the different recognition of the financing and operating lease. So let's chat about, how is it going to look on your financial statements? So either way, for both a financing and operating lease, you'll have your right of use asset and your related lease liability. Now, most balance sheets are not classified, or would have a classified balance sheet, sorry about that, which would really show your current liability and your current assets. So your lease liability technically would have to be broken out into your current portion and long-term portion as well. And this is for both a financing or operating lease. Now, in the income statement, this is where you'll see the difference between your financing lease and your operating leases. The financing leases, you'll have to show your interest expense on the lease liability, as well as the amortization expense on the right of use asset separately as part of your expenses. Now, your operating lease, this is where you'll just see the one line, whether you call it rent or lease expense, and this is presented on the straight line basis, the overall lease expense over the term. We move on to the statement of cash flow. Again, this is where you'll see the difference between the financing and operating leases. For financing leases, you'll have two components. Your financing activities are essentially the cash paid on the principal payments, the reduction of your lease liability. And then for operating activities, this would be the cash paid for your interest component of your lease payment. Whereas operating leases, you just have operating activities, such essentially your monthly or annual cash payments on your lease. There's also some enhanced disclosures as part of your financial statements that are going to be required. You'll have to disclose more of the lease contractual details, the terms of the lease agreements, extension options, accelerating clauses, things of that nature. You'll also have to add in a little more quantitative figures. So the annual lease costs, the assumptions that you use to arrive at your lease liability. So what discounts rates are you using? Did you elect any of the practical expedients? You'll also have to present your future maturities like you do today with any lease, whether it's capital or operating. You'll also have to disclose a policy that you elected on short-term leases. As Max mentioned, that you can elect not to include short-term leases, but you can elect to include short-term leases in your overall lease liability and right of use asset. But either way, that policy has to be disclosed. Also, you should be disclosing any leases that have not yet commenced. So you've entered agreements, but you really haven't taken control of that asset yet. That information related to those leases really should be disclosed in the financial statements as well. There's a few other matters that we need to consider on the new lease standard and how it impacts your financial statements. Generally, your right of use assets need to be presented separately from your other assets on the face of the balance sheet or in the notes. So in essence, depending on materiality as well, always a consideration. You could have it lumped in with your other property and equipment or other assets on the balance sheet, but at minimum, it needs to be broken out separately in the notes. Similarly, your finance and operating leases need to be separated out from each other. And then when you apply or adopt this accounting standard, it has to be applied in a retrospective manner. Now, there's two options. You can either adopt it in the earliest period presented, meaning if you have comparative financial statements, you would essentially restate or revise the prior year numbers to reflect the liability and related asset and any income statement impacts depending on the lease. Or you could adopt it using the cumulative effect adjustment in the year of adoption. My guess is that most people are going to use this method to adopt because again, depending on your types of leases, there shouldn't be a significant cumulative effect adjustment unless you have some leases going from operated to financing once you've actually done your analysis and implemented this. But that typically is usually the the easier way to reflect the adoption. And then finally, you'll have to disclose that this is an actual change in accounting principle, because you're changing how you treat certain matters of your financial statements. This is going to be disclosed most likely, in your opinion, to the financial statements. Okay. So now that we've gone through kind of all the technical components and walking through and describing some of the implementation, let's get through some examples to actually see this in a practical sense. Now, I've kept these pretty basic just for the ease of the example, and kind of show you the impact here. So let's say a company has a 5-year lease. There's a $100,000 annual lease payment. There are no extensions or renewal options in the agreement, and the agreement actually states that it has a 5% interest rate on it. Okay. So first we need to record our lease liability and right of use asset. So how we do that, we present value the $500,000 payment. So $500,000 over the term, discounted at 5%, would give you a right of use asset of $431,000. So debit your right of use asset, credit your lease liability, $431,000. Now let's say you had about $15,000 of direct costs. You know, you had to hire a broker and pay some commission and get some specialized equipment or something of that nature. You would add that to your right of use asset when you initially record it. So now your right of use asset would be $446,000. Lease liability is still at $431,000, and your other credit in this entry would be to the cash actually paid to the broker. Okay, so now if we move on, you have your asset and liability recorded. Let's take a look at how it's actually going to be recognized on an annual basis. So assuming our example is a financing lease right now, you could see that you make your $100,000 annual payments on your lease, okay, total $500,000. You have your right of use asset at $431,000 and amortized on a straight line basis over the 5 years at $86,000 a year. Now your lease liability, again at $431,000, is being unwound or reduced using the effective interest method. And this is where you can see the interest component of that, the $22,000 recognized in year 1, is going to be higher earlier in the term compared to in year 5, where the interest expense is only $5,000. It's the opposite on the liability, a smaller principal payment early on, larger principal payment towards year 5. So to record, let's say year 1 of your activity, you debit your amortization expense for the $86,000 and reduce your related right of use asset. You recognize your interest expense, debit interest expense for the $22,000, debit your lease liability, the principal component of it for $77,000, and credit the $100,000 cash you paid that year. Now the takeaway in this slide is, at the end of the day, you've made $500,000 of payments, and your total expense recognized on your income statement is $500,000. Well, you can see the fluctuation between year 1 and year 5 of your actual expense. So implementing this, if you have a lot of financing leases or operating leases that somehow turned into financing leases, it can impact your P&L a little bit. So a higher expense in year 1 compared to a lower expense in year 2, but at the end of the day, your expense is still only $500,000. Now let's say we treat this as an operating lease. So as you can see, again, you make your $100,000 payments each year, $500,000, and then your lease expense needs to be this $100,000 essentially. Your liability is being unwound again at the effective interest method, and that $22,000 of interest is really being recorded to your lease expense. So that difference to get to your $100,000 lease expense is now the amortization on your right of use asset. So in this case, it's the same amount being reduced from your lease liability as well as your asset. Okay. So now we've gone through a quick example. Let's see how it would actually look on your financial statements. So all the way to the left, you'll see a balance sheet. And again, we'll keep this simple and we don't have current portions, but you would recognize your right of use asset and your lease liability. Now, this one is presented as essentially an operating lease, because in a financing lease, your right of use asset would be slightly lower because that's amortized on a straight line basis. well as your retained earnings would be slightly lower because of, with a financing lease, your interest expense would be a little higher in year one. And this is where you can see on the income statements to the right-hand side of the slides. We'll look at a financing lease and an operating lease. You'll see under the financing lease, income and other expenses are the same, but you'll see the amortization expense of $86,000, interest expense of $22,000. So a total of $108,000, bringing your bottom line to about $241,000. Now on the flip side, on an operating lease, you only have that one line lease expense for $100,000, where your bottom line is $250,000. Now, this does impact, year to year, as I mentioned before, but if you look at it in the aggregate over the term of the lease, your net income will be the same combined over the 5-year period. It's going to be lower in the first year because of the effective interest method under the financing leases, but it will be higher, let's say in year 5. So it evens out over the term of the lease. But this is where you can see it could have an impact on your P&L. All right. So now that we've gone through how it's presented, how it's going to look on your financial statements, there are going to be some other impacts that organizations should really be aware of. So it can impact your debt covenants if you have regulatory reporting requirements or calculations. These changes in your balance sheet could have an impact on these requirements. So let's go through a quick example using some of the numbers from before, and we'll keep it simple. Let's say an organization has, $3.5 million of current assets, $1 million of current liabilities, but now they have an existing equipment loan of $750,000, current maturities of $100,000, and let's just say they pay interest of $25,000 a year. And they have net income of $250,000, and that's what we'll use for our calculation purposes. Now they have 2 covenants as part of their equipment loan agreement. Their debt service coverage ratio has to be 1.25 to 1, or essentially your net income has to be 25% higher than your current maturities of long-term debt. And same with their current ratio, their current assets have to be 25% higher than their current liabilities. So let's see how this would look before implementation and after implementation. So as you can see, we have the first column before implementation. You have $250,000 of income. Your current maturities are $125,000. Your debt service coverage ratio is 2, so you're good. You're over the 1.25. Now after, because now we have some operating leases, that's $77,000 of principal payments we talked about in the previous example, increase your current maturities long-term debt. Now your debt service coverage ratio is at 1.23, so you're only at 23% over your net income. So now you really don't meet your debt service coverage ratio. Now let's talk to the bank. Is there a waiver available? Things of that nature. Similar, you could see the impact on your current ratio. Before implementation, you're at 3.5. After implementation, you're at 3.25, so dropped at 25 basis points. Again, the covenants are still met in this situation, but you could see the impact that it can have on an organization because your liabilities are going to increase, but your current assets are not because it's a long-term right of use asset. So again, the point here is really just that it will have an impact on your financial statements, but it could also have an impact on some of your reporting requirements, your debt covenants, and it's these things that need to be addressed well ahead of time. Okay, so real quick, because I know we're running a little short on time, have everything recorded there, and as you go through your lease term, there are some things to consider, and just make sure you're aware of and assess kind of throughout the lease term. So these right of use assets really should be looked at on an annual basis for any impairment. So for instance, there has to be a triggering event that would essentially indicate the carrying amount or the value of this asset is no longer recoverable. So let's say you have a change in business operations and this equipment that you're leasing is now just going to sit and collect dust for the next 3 years. You probably have an impairment in that asset, and it really should probably be written down to its actual recoverable value. And then that would be the new value that's amortized over the remaining useful life or lease term. You also have to keep in mind lease term reassessments. So Max kind of talked about this a little earlier, but if there's significant changes to the circumstances surrounding renewals or terminations or extensions, if you couldn't, use an extension before or wasn't reasonably certain, but now it is, you could reassess these lease terms as well as your right of use asset and lease liability. And then any lease modifications. So this would really be a change in the terms of your lease, variable payments, residual value, things of that nature. And as long as it can't be accounted for as a separate contract, such as an entire new asset being added, new monthly payment, new terms, that would essentially be a separate contract. Everything else really could be a lease modification, but again, it's circumstantial on how it's really written into it. All right, so I think we have our final polling question here. Which of these destinations is on your bucket list? Amazon rainforest, Dubai, Iceland, New Zealand, or other?
I Googled exotic vacations and this is what came up. So for me, it's a definite other.
Yeah, I would agree.
I could spend all day, every day in Italy, as most people who know me know that is true. We'll just give it another second. Okay, I'm going to end the poll. It looks like New Zealand is the winner here. So, interesting. Okay, we'll keep going here, Bob.
All right.
Thank you.
Yep. All right, and just to kind of wrap things up here, what can we do to get ready for this? So we're still, 2 years out from implementation for most organizations. But our recommendation here is be proactive on this. Start taking inventory of your leases. See how many you really have out there. And it's not just buildings, offices, it's printers, fax machines, whatever it may be. Make sure you kind of have a handle on what you actually have out there. So then when you're ready to start assessing these, they're all together. And then also think about how you're going to track these. If you have 10 leases, it might be easy just to do an Excel or something like that. But if you have hundreds of leases, there's software out there and other things to consider for the ease of this. And then start thinking about the potential impact of it. Is it going to be a financing or operating lease? What's my incremental borrowing rate, or will I, elect the practical expedient? Because then you'll get a feel, is it going to add, a couple $1 million of liabilities to your balance sheet, or is it, only going to add a few $1,000s if you have all, 1 to 2 year leases on things? And then, talk to your bank, especially if you have, debt covenants or you have other regulatory reporting requirements or calculations. Get ahead of it and talk to them. Are leases going to be scoped out of these calculations? Are the agreements going to be amended to change the covenants or the ratios? Just so then everyone's on the same page when you are ready to implement. And talk to your CPA, talk to us or your advisor, be proactive on it. We're here to help with any of this. And the earlier you can get a handle on it, the better and smoother implementation is going to go. I know we're approaching 12 o'clock right now, and I know that we did promise a little PPP and employee retention credit content, because what's a webinar these days without these two topics? But real quickly, just on the accounting for them, because we've had a ton of questions over the past several months on how to record these, but essentially there's no formal guidance issued from FASB. And the AICPA came out with some guidance, a few months ago or maybe last summer related to PPP funds that you really treat these by analogy to other guidance. So in essence, the AICPA was saying for PPP funds, you can record them as a debt instrument, whereas you recognize the cash and related debt, and you don't recognize any forgiveness into income until the bank's has formally proven your forgiveness. Or on the flip side, the analogy to a government grant or conditional contribution, where you receive the cash and refundable advance up front, but recognize the income from forgiveness when the company believes it has met all the required conditions for forgiveness, even if it's before the bank has awarded formal approval. Employee retention credits are very similar and follow the grant or conditional contribution analogy. Again, there's no authoritative guidance on this. or anything issued on it. But logically, it would follow the same thought process of PPP, that you would recognize the income and related receivable once the company has determined that it has met the eligibility and conditions of that program to receive that credit. So it is 12 o'clock. I think there are a few questions in the poll, Maria, if you think we have time. If not, we can certainly touch base with the attendees offline and go through these questions.
We do. It's just 12:01. So if for those who are interested, they can stay on the call. So we will get to those. Kristen and Al had a couple questions. So I'll read the first one. What happens when a contract for a service has an evergreen clause? Contract will renew for like terms contract will renew for like terms if no termination received.
My guess is she's asking, would she include extensions or not? And again, if it's a contract for service, I don't know if it would fall under technically the lease standard. Correct me
Right,
if
it would
I'm
have to have
wrong
an
on that.
identified asset in the right of control.
But let's say you're asking it like this is a lease. Let's say it's classified as a lease. I don't know if it'd be practical to include any extensions if you don't even because you wouldn't know the finite life of the lease then.
Yeah.
Okay, so a second out of our three questions. Would agreements to use software as a service be considered a lease?
I think it goes back to what the agreement states and if you have any control over that asset, do you receive the economic benefit from it? So I think it would have to fall back on the agreement, and we probably need a little more information on the details of that. If you're the only user of that software, maybe, but I wouldn't necessarily think so. But again, the agreement would have to be reviewed a little more in detail for that.
Okay, and Al has a two-part question here. Part one, Company A has an operating lease that meets all ASU criteria and allocates percentage of the lease payments to the related party, which is Company B. First case, A and B consolidates, and second case, A and B don't consolidate. Should Company B apply new ASU if there is no consolidation with Company A? If you guys pull up your Q&A, you'll be able to see it.
Yeah, I'm just rereading it now. I mean, in either case, if Company B has leases and related party leases has to be followed by the actual terms of the related party agreement, it would have to apply ASU if it is going to be reporting under US GAAP. If that answers your question. If you say, I'm reading it as there's a standalone financial statements.
So did we get to part two? Did you answer that second part? Company has operating leases that meet all ASU criteria that as of January 1st, 2022 have less than 12 months left. Does the less than 12-month rule apply?
I would think so. Max, do you know off the top of your head? I would think that does from the date of adoption.
Yeah, I'd have to look into that a little bit more, but I mean, if it had less than 12 months of remaining term on it, then I think it'd have to be assessed at that point.
Yeah, Al, if you want to give Bob and Max a call or reach out to me, and I can, put you in contact with them. We did get a fourth question real quick. It's 5 after, and then we'll close out. Would leased parking spaces be covered under this ASU?
If it's a separate identified lease and asset, I would think so. If it's already a component of an existing lease, and that lease is recorded, I would not think so. again, it would also depend on the term of the lease and, the control of the asset. So again, the agreement would have to be kind of dug into a little further.
Yeah, this person was anonymous, so if you're obviously still listening, if you want to reach out to us again, we can read your specifics and then provide an answer for you. So we will conclude with that. But again, thanks to Max and Bob for presenting today. They both did a great job, and hopefully, like Bob said, the best thing to do is be prepared, and proper planning is always helpful. So any questions, reach out to us. Otherwise, we hope to see you on August 10th at our final webinar on the pandemic and the economy. So everyone have a great day.